All right, so I'm Lucie Lalumière. I'm the president of Interactive Ontario. So welcome to you all. This is the first event of a series on the relief measure under COVID-19, but as they apply to the interactive digital media. So for us, Interactive Ontario, it was very important to make sure that the information that we're going to convey is applicable to our industry and that we answer questions that our industry has about the measures. So the first thing I want to do is thank the team at BDO for working with us to offer this first session. And as I said, it's the first of a series. We're going to have, hello. Okay. So we're going to have more coming over the next few weeks. So today we're going to discuss the wage subsidy as well as the NRC IRAP COVID-19 program, which is called the Innovation Assistance Program. So first, I'm going to introduce you to Mary Sorrenti. Mary is going to moderate the session today. So Mary is the VP of GamePel and VRJam. She oversees finance, business affairs, and production at both the companies. Mary is also a CPA. So she spent half of her business life as a CPA and providing advice on tax and business to some of the top companies in Canada. And then she found her place in the interactive digital media industry. And I have to say, we're very happy about it because Mary is very active in the industry. She sits on the board of Interactive Ontario, and she's also the chair of Interactive Ontario's Advocacy Committee. So we're very thankful for Mary and her dedication to our industry. So without further ado, I'm going to pass it on to Mary to kickstart the session. Mary?
Thank you, Lucie. Good morning, everyone. As we all know, COVID has affected almost all businesses in Canada and around the world. In March, the government announced the Canada Emergency Wage Subsidy, or CEWS, and on April 8th, Prime Minister Justin Trudeau announced changes to CEWS to make it easier for companies to qualify. However, for many, including IDM companies, there are still many questions about this subsidy. As the program opened yesterday, the goal of this webinar is to answer your questions and to gain a better understanding as to how IDM companies specifically may be eligible for the CEWS. Today, we will speak with Paul Walker, Canadian tax partner at BDO, as well as his colleagues Jamie Barron, partner in audit and assurance, and Rick Berdanyuk, senior manager tax, shred, and government incentives. And we will speak to them about answering your questions. Gentlemen, there's a lot to cover, so let's get right to it. Actually, right before we begin, I just want to let everyone on the call know that there is a chat box at the bottom of your screens. Feel free to ask your questions as we go through the webinar. Just know that we're going to try to hold the questions to the end, and we'll have a Q&A period where we'll try to get through as many of the questions as we can. So now, I think by now, most of us have read the general guidelines of the CEWS. We understand that companies have the option of selecting the best method to determine their revenue for the current and prior periods. However, one question that keeps coming up is, cash or accrual accounting, and what is accrual accounting? Can we use a simple example to illustrate how a company can recognize revenue for a service contract applying accrual accounting versus cash accounting? Paul, Jamie?
Sorry, just on mute there. So thanks for having me on this webinar. I just from the top, but just make sure that as a qualifier that we'll do our best with the questions and answers. And some of these areas are gray, and just a reminder that the ultimate requirement and pushing that submit button on the application is that of the individual making that submission, and they should really understand what they're submitting is true and correct to the best of their knowledge. From an accrual accounting versus a cash accounting method, we've got an example that you've provided or we've been provided as a sort of flow through. So if we can switch to that next slide of the example. This is typically a cash method of accounting. When you're receiving certain amounts of revenue under a contract, you initially receive something on signing, and then through various milestones, you receive those cash payments. You'd be able to invoice and get receipt of those payments. And how do you contrast and what is accrual accounting? And what I would say is accrual accounting would take in consideration the specifics of the deliverables in each of these milestones or the payments that are being received. And it would be the deliverables that are within that contract and determination if those deliverables should be recognized up front or have they actually been delivered. This could be either early recognition as an accrual for a receivable as opposed to a cash receipt, or later recognized for services such as warranties and support and maintenance on the back end of a program. The key is that revenue be recognized over the earning process and on the contract terms. So to give a simple example, on initial signing of a contract, you're receiving this money up front. There may not be any specific future events that could be considered to be earned on that initial payment. It's money, you're going to do this, here's the money I'm paying you to start this process. But that money might be tied to or have some sort of recourse and tied to each milestone that you have to deliver. And therefore, revenue most likely would have to be recognized over those specific milestones. And specifically, those milestones might also include, from initial payment, the warranty, support, and maintenance, and on the back end. What I like to do, though, is I like to bring Jamie Barron to make some comments and observations on certain audits he's done and contracts that he's reviewed, and give some understanding of those type of transactions and his observations. Jamie, I'll turn over to you for a second.
Super. Thanks, Paul, and good morning, everybody. It's Jamie speaking. So as you can see from the example there, this is a fairly straightforward contract, at least in some regards. We've got a deposit up front and then different stages of the project, which when we hit those milestones, cash payments are made. And so intuitively, it makes sense. And the cash basis of accounting, in fact, is quite simple. When you get the cash, you record income or revenue. So that is one method that's available to us under the current wage subsidy program. The accrual concept are a little trickier. And for those of you who aren't quite as familiar with the accounting around that, really what it refers to, as Paul has touched on, is the earnings process itself. And so what that means, if we focus on the deposit, for example, upon signing, it may simply mean that here's a deposit to be used over the course of the contract, but it doesn't mean we've actually done anything, doesn't mean we've actually earned anything on the date of signing. So the upfront deposits in particular tend to be the types of things where we can see a difference in accounting. So it might mean that we're earning this contract over the better part of a year, and that deposit amount, in fact, is going to be recognized over the better part of a year based upon the specifics of the contract. And I'll just pause and make note of the fact that the specifics of that contract are very relevant when we're trying to figure out revenue recognition. It's the type of thing that if you're in an actual fiscal year, so let's say you're following a calendar year basis, under this particular scenario, when you think about it, all of this would be recognized and earned over the course of that calendar year, presuming that you sort of stay on target with the timelines that are set out. So it may not be something that you thought of before, but because we have specific reporting periods associated with these wage subsidies, the need for us to become granular in terms of accounting month by month and doing so with a fair amount of accuracy is actually very important. As well, the actual determination of these revenue drop calculations is in relation to prior periods. So it's not just the current year that we have to account for accurately. We need to have a comparable basis from the prior year. So what we're finding with some of the companies that we're working with is that is creating a bit of an exercise. If your accounting is crisp and very tight on a monthly basis, accounting for things on an accrual basis, you're probably in pretty good shape. But quite frankly, many companies at this stage and in this industry don't necessarily do it like that, because in the normal course, they don't necessarily have to. It's not necessarily a business imperative for them. So the importance of working with your accountant to understand the revenue flow that should be there and determining the calculation that needs to be there, accrual versus cash accounting, is really important. And obviously the need to be consistent of that is really important as well. So again, there's a lot to be considered there, but what it does come back to in general terms is that if we have, I would say, deposits that are being received upfront, that is usually an indicator that we're going to have a difference between cash versus accrual account. It's not the only thing that can drive a difference, but if you're thinking about your own contracts and your IDM business and the type of things that might trigger a difference, that would certainly be a common scenario to think about. So I'll leave it at that, Paul and Mary, but happy to take additional questions at the end as well.
Thanks, Jamie. Sorry, go ahead, Mary.
So Jamie, would it be fair to say, if, based on this very simple example where let's assume there's no warranty period, the contract essentially is a 12-month production schedule, nothing at alpha or beta would be considered market ready product. So would one option perhaps be that they take the 120,000 and divide it by 12 and recognize it on a monthly basis at 10,000 a month?
So yes, that is one alternative. So you might well take the full value as you've described, Mary, and recognize it. We call that ratably or evenly over the 12-month period. So 10,000 a month, that's one possibility. It depends on the nature of the deliverables though. And so we might look at that and say, well, if until we deliver an alpha, really nothing has been provided to the customer. Like there's no code we could turn over that's complete. There's no other deliverables that are really have been satisfied. And so it may well be that even recognition of the contract over 12 months makes sense. But I could also see scenarios, and I do see scenarios where that doesn't make sense. We really are bound very tightly to the actual deliverables in there. So the alpha might be the first point at which we can recognize revenue. And it may well be that the $30,000 payments they're just a smooth cash flow, but aren't necessarily reflective of the actual effort that's required. So we might see, for example, 80% of the effort to get to beta and a residual 20% to get to gold, or something other than that. I'm just using a random example, but it doesn't mean that the flow of effort and resources that are being expended is in fact equal. So it might differ on that basis as well.
Thank you. So perhaps then the best advice would be use whatever method you've historically been using and see if you qualify to make life simple for everyone before you start looking at other options.
That's right. I think that's good advice. I mean, generally what we're finding is that companies use their typical reported revenue. And when they find out that that works and it fits the criteria, great, they just move on. When they find it doesn't fit the criteria and they're not eligible, that's when they start thinking about, okay, wait a minute, should I look at cash basis, or is my accrual accounting actually reflective of this? And so I was talking to a client the other day where literally they had a significant large deposit, like the types of what we're talking about. So from a cash perspective, they were offside, but when they went to an accrual accounting basis, they were onside. Typically speaking, they account for a cash basis throughout the year because that's really just what they need to do. And they convert their records to accrual at the end of the year just to true up. So it can vary from company to company in terms of what your typical practices are, but start with what's consistent because it's what you already do. And hopefully that's a box that gets us in the right bucket. But if it doesn't, then we can look at plan B.
Thank you. Many IDM companies receive Ontario Creates IDM funding as part of the way in which they fund their internal projects. Typically, would that be considered extraordinary revenue for purposes of the CEWS? Or is it possible that a company could deem that to be revenue if they have a history or can show consistency in receiving the funding on a more regular basis?
Yeah, I think that's a great question. So actually, Rick, would you like to take this one? Because I know that's something that you've looked at a fair bit.
Yeah, I'm happy to take it. And I think to answer it requires a little bit of interpretation of the company's business operations and the context we're asking the question in. But if this is a company that's registered as a video game developer, and that's the NAICS code they've used in their corporate tax return. So this is a part of their regular business. They're a software publisher using 511210, and they regularly benefit from the OI, Ontario Interactive Digital Media Tax Credit. I think it's safe to say this is regular revenue and that most of this funding is attributable to projects that are within the company's primary purpose or primary business. So In most cases, we don't see an issue with this being treated as extraordinary revenue. This is considered a normal revenue. There is some flexibility. Apologies. There is some flexibility for not-for-profits to move that out or exclude it, but for commercial businesses, we think that revenue should be included.
And would the same be true for IDM funding, so the grants?
Yeah, so ultimately that funding is tied to your regular business activities of developing games. So if that is your company's primary purpose, this is an unusual activity for you, then I don't see an issue with treating this as standard revenue. But of course, we don't have a lot of case law on this yet. This was legally drafted just a few weeks ago. So, but I think we're okay to proceed as is with standard revenue.
Great. What about the revenue qualification calculation? I know, again, there's been a lot of questions around this. So in the eligibility criteria, it talks through the March, April, and May periods, and whether the revenue reduction allows you to qualify or not. Did you want to walk through that eligibility criteria for us, Paul?
Sure. So unfortunately, this is hardwired in the legislation, and it's not hearsay or rumor. It's specifically there to help companies on the timing of bringing employees back and making that determination versus the timing of actually determining whether you qualify, which could be maybe a retroactive type review. So in the legislation, if you do qualify for a specific period, you automatically qualify for the subsequent period that would follow. So if you qualify for the 15% drop in March, you would automatically qualify for the drop in April. Also, we understand, sorry,
Paul, can we just go to the next slide? It might help to have the illustration live.
Okay, there we go. Yeah. So these are the periods. So when we look at the periods, we got to make sure we're looking at the right periods just to be certain. The claiming period in this slide, that's the claiming period of the salaries that you're receiving or you're paying out, and the subsidies based on the claiming period of the salaries. However, the reference period when you determine whether you qualify for the revenue over revenue, either year over year or the average of January and February, if you so elect to do so, either using cash or accrual. So there's a lot of ways of determining whether you qualify. If you qualify on the reference period in the first reference period, then you would automatically qualify. So in this example for March, if you qualify for 15% reduction for March, you would automatically qualify for April, regardless of the fact that you don't qualify for April. If you were to redo the numbers and determine that you don't meet the 30% reduction, you still qualify for that April period.
So I think my first question is, if I were to do my calculation under either the cash or accrual method, and I qualified for March and I also qualified for April, but based on my calculation, I would not qualify for the May period, would I be able to be deemed to qualify for the May period because I qualified for the April period?
So our understanding is that the legislation is pretty specific in that it states that if you qualify for one period, you would qualify for the subsequent period. So we do not believe that it would prohibit you from re-qualifying yourself for April, which would then automatically qualify you for May, given the fact that it is a prospective type of determination, because you'd be paying out the salaries to the employees that you're encouraged to bring back. So our current understanding right now of the determination of that written legislation is that you could requalify yourself for April to show that you have the 30% drop. That should then pre-qualify you for May.
Great. And I think the other thing that's important to note is whether you choose to do the cash or the accrual method, when you're looking at if you qualify for each of these periods, it's important to recognize that whatever option you select, whether it be cash or accrual, that you need to use that method both for the prior period that you're comparing to, as well as for any subsequent period. So you can't choose whichever method gets you into the bucket for each period.
Correct. And that's a key point. Once you pick a method, essentially there's 4 different ways you can do this, either cash accrual and either the year over year or the 2 months prior. Whichever method you pick in that mix, you are stuck in that method, and you've got to be consistent, and you've got to continue on with that method. So that's key. But I would also make a note of the fact that when you do have a method and you do have a method that's picked, when you are determining your revenue drop, you want to make sure that you're not artificially trying to include things or exclude things, like delay a cash payment on purpose because you want to qualify. That if you're doing that type of activity, that could be considered anti-avoidance and could put you in the very severe penalty provisions for essentially doing a claim that shouldn't be put in the first place.
That's a really good point that you raised, Paul. Given the fact that many companies are struggling with cash flows right now, I can imagine many scenarios where clients have delayed payment on their end just simply because they didn't have the funds to pay you, maybe on whatever date you had originally contracted to. So how would you as a company be able to prove, or do you need to prove, that the delay in receipt of cash was not on your end, but in fact on the client's end?
So I'd say from the top of that determination, the more that parties are acting in concert, or they have more of a tie of their business or lack of independence or something along those lines, where they would look or appear to be non-arm's length in a determination, then it gets really hard for you to argue a delay of payment if there is cash available for payments or something along those lines. And I guess it really comes down to any type of information that's available at the time that shows that there's a delay of payment on for a reason. I think it just comes down to the quality of facts at the time that you have that shows that there's a determination that the company paying just can't sustain itself if it actually makes that payment. And in a situation where it's arm's length, I think it's more quite clear that that company has its independence to make a determination of who they pay, how much they pay to manage their own cash flows. So I don't think there's much of a risk in that area, just as long as that it's clearly showing that these parties are not acting in concert to be able to manage their affairs between each other to qualify for the benefit.
Great. And so in instances where, perhaps I've normally used an accrual method of accounting, but for purposes of the CEWS, the company has opted to use the cash method. Do you need to go back and formally restate the prior period financial statements and tax returns, or do you need to change your method of accounting for that current period?
No, I don't think so. So just stepping back to the original question of accrual accounting, the wording in the legislation is that you use your normal method of accounting when you're using accrual accounting. So whether that be Canadian ASPE, or that's a US GAAP or IFRS, or the methodology that you actually have in interpreting contracts, that once you have a method that you normally use, that's the method you should be using for your accrual method to be able to look at these specific periods. So keep in mind that you're doing a calculation, you're determining things based on these specific periods as if it's a stop in time for that particular month. So a year-end financial statement is quite different, because a lot of these events could override themselves throughout the period and be within a 12-month period. But you should be continually using your same accounting methods that you would normally use for year-end. Those are the methods you would use for determining these cutoff periods. And specifically to the question on cash versus accrual, you would not restate your statements to be cash method for your year-end financial statements and your tax returns. So I don't believe that there's any reason to be changing any type of method for your overall income tax and final reporting, as opposed to what you're doing for these periods.
Great.
And Mary, it's Jamie. If I could just add one thing, and I know you're responding to a question that was in the chat box, but the other piece of it was the question also includes a notion around, would the company have to make projections before deciding on a method, understanding that we're talking about multiple periods here. So while we do have some things that are known, we're also trying to look out to March, April, May, June, right? And trying to figure out which method could be most advantageous, I presume. So Paul, do you have any kind of insights or just thoughts on that? And I can add a few comments too if you want.
Yeah, so what I would add on this, and just to be careful on when you're making your projections, it is a period by period overview, and making projections, just making sure that you're not actually timing out those projections to get into what I was talking to before about excluding things or including things, and actually planning for that to be able to qualify for those periods. So doing projections is fine, but making sure you're not putting in activities that are trying to get you to get to the answer that you want to get to. What I would also add to that, Jamie, is that this program has the ability written in legislation that could be extended not further than September before they would have to make other measures to be able to extend it past September. So keep in mind that when you're using your projections, that this program could be extended all the way through the summer. So if you're making those projections, just understand when you're picking a method that you might want to look out all the way through, say, September, about where you are going to be or where you think you're going to be when you're making these cash versus accrual decisions.
Yeah, and that's a key point. If I could just pick up on that for a second. So when I'm talking to companies, I think in general terms, we're advising like do your cash flow projections for a minimum of 6 months. Now we all understand that there's a lot of variability and uncertainty, and who knows how accurate we're all going to be with that. But at a minimum of 6 months, there's a lot of reasons to do that. One for sure is the CEWS and related wage programs, just so you get a sense of where you think you're headed. But obviously there's much broader, business management objectives with doing that, and cash flow management as well. As you'll hear, those projections are going to be used for other things such as loan applications and so forth in the normal course.
So once we've made a determination, we've selected cash or accrual, we've done the calculations to assess what periods we may be eligible for. What type of documentation or records should we maintain if CRA were to come knocking on our door at some future point to assess whether or not we in fact should have qualified for this subsidy?
So it's a very good question. It's a very good point, Mary. And so I'm happy to talk to this and making sure that your audience does understand that documentation is king. And when I say that, is that documentation at the time that you're making decisions is very important. So contemporaneous documentation of why you're making decisions, you should have in your file. You should be keeping it in your file now. And when I say that, that is more on the lines of making sure you don't fall under any type of anti-avoidance or any type of penalty provisions, that you're not making up information and trying to put it together when CRA comes calling for an audit. And I think we'd be sure that there would be a lot of audits come down the road on these measures. So you want to make sure that documentation, your reasoning is there, specifically if you were to look at the extraordinary question that Rick answered to, and whether you make a decision that you feel that some of that funding might be extraordinary, although it could be a stretch in that example, you'd want to make some very good documentation in your calculations. So what you should keep is all records and calculations, the actual calculations that you use to support the revenue drop that you're assessing, and the reasons why that you're doing that, and then most likely a written dialogue of why you're making determinations of certain items. Write it down, put it on paper, make sure it's in a file, make sure it makes sense, and that you are taking a reasonable filing position. And the second is on the employee side. It's not the employees. Employees are not the ones that need to keep records, it's the employer. So make sure you're keeping all your employee records, specifically for determination of what their overall remuneration is, and overall what their benefits are, and also the specific days that they worked, and making sure that you're matching up days to work to days that are being paid. And you also want to make sure that when you are determining a drop in employee salary, so for example, you're reducing an employee salary because you're managing cash flow and then you're going to get the subsidy to cover up as much of that salary as possible. On the back end, you're not doing anything to increase an employee's salary specifically to take advantage of the wage program. That would be offensive. So making sure that you're documenting pre-crisis revenue to current, pre-crisis remuneration to current remuneration, and that you're proving out that that the remuneration is not something that's increasing over above a normal employee salary and wages.
And I think that's an important point as well. When we're talking about the periods of time, the reference period for purposes of determining revenue, that's a calendar month. So March 1st to March 31st versus the wage claim period.
Yeah, that's exactly right. And so the wage claim period is a different period. So there's been some confusion. I've seen some applications that are being ready to be submitted, and the periods are not the correct periods. Either they're doing the revenue period on the cutoffs of March 15th to 11th, or vice versa for the salary being the actual month of March. So it's just a matter of being careful on making sure you're picking up the right periods when you're doing the calculations. Salary is the specific claiming periods, the off calendar year, and the revenue is the calendar month ends that you're looking at in this regard.
And when we're calculating the revenue, there's no threshold. So if I have zero revenue in March 2020 and I had $500 of revenue in March 2019, like, is there a materiality aspect that we need to consider, or, you know, is it irrelevant?
No, it's irrelevant. It's specifically the reduction in revenue, and it's an over one over the other, and it's a percentage, and that's how you qualify. There's no specifics on a threshold of actual dollar amounts at all in that regard. But Barry, I just want to make one point on remuneration before I forget this. It's specific to when you're looking at technology companies, life science companies, digital media companies. A lot of employees are being paid in stock options, and that's a form of compensation to bridge gap for funding and things in that nature. I just want to be clear that stock option benefit that you would normally calculate, which is be taxable to an employee at some point in time based on the stock option rules, those stock option benefits are not included in the overall compensation for an employee. You need to back those out.
That's an important point. Thank you. Is there any sort of requirement? I mean, IDM companies, we may launch a product in 1 year and not have a product launch in a subsequent year. So, you know, there may be a natural trickling down or reduction of revenue based on where we are in our life cycle. Is there any requirement for a company to attest that the reduction in their revenue is related to COVID, or does it not matter as long as they can show that they've had that revenue reduction?
I think my understanding is just based on revenue reduction. It doesn't seem to say anywhere in legislation that you have to have a COVID reason related to why your revenue has dropped. It's specifically about revenue reduction, maintaining employees, and being able to pay those employees while they're off work. And I'll sort of give you a background example in this regard. If you have business that you know has some sort of nature to its cycles, and an employee is expected to work for you for a number of months and make money, and then they would go on to another job where they work and they make money in that job. Because of the cycle in nature going up and down, it would make sense that that employee would be without ability to go to that next job and make money to supplement or whatever the case may be. So it is intended to support employees, support individuals that would be without remuneration, and to keep people off the EI rules as much as possible.
Great. What about owner-managed companies? So Ontario has several, you know, small indie studios where the owner is an active employee. Perhaps they're, you know, a husband and wife partner team, or they have siblings or other related parties working for them actively on their payroll. Are there any limitations to related party payroll that we need to be aware of or cognizant of?
So Yeah, there are, and that's a key question. And the first is, and this is sort of general for all companies, you have to actually have your payroll number registered for your payroll number as of March 15th. So if you don't have a payroll number because however you've been compensating yourself, or you're pure startup, or whatever the case may be, if you don't have a payroll number by the 15th, then you fall out of the legislation. Bearing that, if you have a payroll number for a non-arm's length employee, you can't have an employee non-arm's length start work after March 15th and then qualify for the wage subsidy, as opposed to an arm's length employee. You can have a new hire and they could qualify for the wage subsidy. So that's a key measure, that a non-arm's length employee cannot be put on payroll after March 15th. Their services would not be included. And that's specific in the written of the legislation, is that the remuneration standard is looking at the pre-crisis, so January 1st to March 15th. What was your regular average weekly earnings over that period? And then 75% of that would be your cap, up to $847 a week. That would be your cap that you can claim. So if an owner manager has not paid themselves remuneration prior to March 15th, they would not be able to qualify for the wage subsidy. And the question's been asked of whether or not dividends or other types of form of compensation would be considered. And in this legislation, there is nothing written that would say that dividends or other types of amounts would be considered remuneration. It's specific to salary and wages and reported salary and wages up to March 15th. So caution owner managers that if you don't have that remuneration, doing things to put that remuneration in place could be offensive.
I want to address a question and also try to help some of the people on the call to say, when we're looking at this, first you were just talking about compensation there, but if we consider the drop in revenue for some of the companies that didn't have revenue last year, I want to re-highlight that January and February as a baseline option is also a part of this program. We were getting some questions to say, you were a mid-sized company without a lot of revenue so far. And so I want to point out we can measure that drop from January and the average revenue in January and February in comparison to these eligible periods. This is still an option, and there's other programmings coming up. If you don't have any drop in revenue, we'll get to in just a minute, so stick with us. Back to you, Paul. Mary?
Yes, I think that's an important point to point out and consider, to really look at the full picture of how you may be able to fit into this model. Any comments that you wanted to make with respect to perhaps employees that were laid off initially and have maybe been brought back onto payroll because of perhaps this wage subsidy? Is there anything that an employer needs to be aware of and understand so that they don't get into a situation where perhaps they need to repay a part of a subsidy that an employee has received?
Okay, so this is actually written in legislation as well, and it's become quite clear how this is going to work. So we have the emergency relief benefit, which is the employee EI benefit. So if an employee was laid off without remuneration or let go, or whatever the case may be, they would then go to look to qualify, and then there's qualifying periods as an income threshold test and a number of days worked test as well in that. But if they qualify for what we call the CERB benefit, so the Canadian Emergency Relief Benefit, they would get $2,000 a month for not working and to be able to sustain themselves. The wage subsidy program is meant to hire back employees all the way back to March 15th. So even if the employee didn't work for you, you can go back and hire them for that period and back pay them for that amount that they did not receive, and then seek to get a wage subsidy. So that's clearly what the program is designed to do. The interaction with the CERB benefit is that if an employee is hired back, then when they're doing their CERB application form, there's a reporting mechanism where they have to then make a determination if they were compensated on those days that they were off, and what was that compensation. And in most cases, that would make sure that the compensation they received would disqualify them now for the CERB benefit. So the onus is actually on the employee the employee would then have to remit that money back to Revenue Canada or to the unemployment rolls. And it's not the responsibility of the employer. The employer will not lose their subsidy because an employee's received the CERB benefit. They get their subsidy based on the fact that they paid, and then the employee will be the one that have to pay back whatever CERB benefit they received. So I would say is a good practice between employees and employers. The employer should, when they hire the employee back or they're paying the employee, that they indicate that they are taking their salary and claiming the wage subsidy, and that the employee needs to make a determination whether or not they have to repay that CERB benefit and report that income correctly within their application for the CERB benefit.
Great. And I know information is changing daily. There's been updates to this program. Other programs are being announced. Based on the information that's available to us today, if a company were to apply to the wage subsidy program, are they precluded from applying to other subsidies or grants that they might be eligible for, whether they be a COVID-specific type subsidy or something like SHRED, OIDMTC, the IDM Fund, CMF, etc.?
Okay, so the first one is the 10% subsidy that a small business corporation initially could receive. That's based on reducing withholdings that you would normally remit to the government. There's a 10% subsidy. And so a lot of companies did so, and a lot of companies still are, because they're determining whether they actually would qualify for the actual wage subsidy in any type of period. So companies in general are still applying for that 10% reduction, so up to $25,000. And then when you do your actual calculation for your wage subsidy, if you've received the 10%, then you would reduce the amount of the wage subsidy that you're qualifying for or you're asking for. So that's the first measure between the two specific grants that have been announced for COVID specifically. On the other side, any amounts you receive from the 10% or the 75% is considered government assistance, and is considered current year received government assistance. So it'd be taxable income in the current year. And Commentary Finance has specifically stated that any subsidy that you are receiving within these programs that is received for eligible salaries for an eligible employee, that those salaries would be also salaries that if that employee was engaged in the activities that are for certain grants, SR&ED type events, that the wage subsidy would reduce the eligible expenditures for salary and wages for that specific grant. Now, it's a very complex area. It's got a lot of mixes to it. So I really like to have Rick comment on what he's seeing in the commentary that he's providing his clients, because this is a little bit of a double dip, and it is unfortunate, but this is the way that the program's being rolled. So Rick, I'll let you make some comments.
That's 100% right, Paul. Let's start with some simple things. By no means am I trying to discourage people from applying for CEWS. It can be extremely lucrative. For a 10-person company, just for these 3 periods, we might be seeing up to $100,000 a subsidy, for example. But that is going to be treated as assistance, because that money received is attributable to person hours, the same person hours you would include in SR&ED or digital media tax credit claims. So we do expect that to be treated as government assistance going forward. And there isn't a lot of room there to avoid that if we have the same person hour claimed for multiple programs.
Mm-hmm.
But Mary, your question was really about other COVID programs. I want to address that. So there is interactions between, as Paul said, TEWS and CEWS, the 10% payroll reduction versus this wage subsidy. Mm-hmm. There's complementary access, between some financing programs like CEBA, a $40,000 loan with great terms, potential forgiveness and negative interest rates, and business credit availability program where you might borrow money at special terms and still receive the wage subsidy. No issue there with those two interacting, which is great for the businesses on the call. So CEWS is a very important program, but can be complementary with others. It can also interact with something called work share, where you might put people temporarily on EI or have them working reduced work weeks for you, Again, there's a complementary overlap between CEWS and WorkShare where you'd see a reduction, but still it's in the company's net benefit to claim both. So no discouragement there. Again, they do what's right for your business. Last but not least, there is one notable conflict, and that is the IAP program that we hope to discuss soon. Its first eligibility question is to attest you do not qualify for CEWS. So we've just discussed CEWS, the 75% wage subsidy. And so if you don't have the revenue decline to qualify for CEWS, stay tuned for the NRC IAP program, which doesn't have the same revenue test, but is also a wage subsidy.
Great, that's
Either
a
or.
perfect segue to the next topic. There is one question in the chat box that I wanted to touch on quickly before we move to the IAP, because it's specifically related to the CEWS. For early stage companies where revenue is derived from a few customers, how do you look at the qualification criteria in an example where work began during perhaps March, April, and May of 2019, but it wasn't invoiced until, let's say September or October of the same year?
So if I read that question correctly, then I think then you're looking at potentially using the cash method as your determination. So you can look at it in two ways. You can do the cash method because obviously cash has not been received in the qualifying reference periods or the reference periods for eligibility for 2019 because it wasn't received in March from a cash basis. But potentially you've got to, if you do the accrual, then you would be looking at accruing that amount. Then further that out is if it's very complicated as going through from a startup perspective, that is why we've got the January, February average of January, February period that you could either use the cash or the accrual method there and then compare it to your current March, April, and May period. So hopefully that answers the question.
Yeah, I think based on this, if it's an early stage company, perhaps they're looking to try to show revenue in 2019 because perhaps there's no revenue in 2020. So I would suggest maybe seeing if accrual accounting would allow them to account for that revenue in 2019. But obviously they need to speak to someone like yourself or their accountant to determine if that's appropriate.
Yeah. And so a year-end test, if you're looking for revenue for the year, then a year-end test on accrual is one thing. And then for these qualifying periods, you could just specifically use the cash method to make your determination. So just because you're trying to show revenue by accrual in your year-end financial statements doesn't preclude you from using the cash method in determining these specific periods to qualify for this benefit.
Excellent. So I think we've answered a lot of the CEWS questions for companies that have revenue and can look to try to utilize this subsidy to receive funds to help with payroll. But what about early or startups, pre-revenue companies, those that don't have revenue that would allow them to qualify? Rick, you had mentioned the NRC IRAP Innovation Assistance Program, better known as IAP. What can you tell us about that program and how would it be of interest to IDM companies? Rick or Paul, I'm not
This
sure.
is Rick. Yeah, I'll take it for now.
Yeah.
And Paul, I'll invite you to comment as well. So it is absolutely of interest, and I want to stress urgency here. Applications are due for the first intake April 29th at the end of the day. So if we look at it today, you've got about 18 hours to get these applications in if this program's of interest to you, IAP, and certainly it's worth circulating a link. So it's a program that is a wage subsidy, an alternative to that CEWS. For companies that are innovating inside of Ontario, there's a number of questions you'll be asked, but it is a fairly simple application. There's no need to upload cash flow statements or anything like that. And I'd encourage everybody on the call to consider it if you will not be applying for CEWS. I want to stress that. I encourage everybody on this call, I think, should at least consider IAP. It's worth your time to investigate if you can't qualify for CEWS. Notable changes, though. Go ahead, Mary.
Sorry, so I guess just a few quick questions. One is, do you need to be a current or former client of NRC or IRAP to qualify, or is it open to any company?
It's open to any company, but there are some requirements that you have been incorporated prior to your application. I think the date is March 1st. So we can't have people creating companies in order to apply, but if you had a CRA business number and were incorporated before March 1st, you should be looking at that if you're on today's call.
And is there any criteria? So, again, we would encourage anyone to apply if they believe they're outside of the CEWS criteria, but are there any sort of companies that you think, or in your opinion, would be a sweet spot for this type of subsidy?
We can read a bit into the application. So we do know a few things, and we've heard it's going to be a merit-based program, which means a stack ranking or competition, that the best fit applications will be funded first or most. Those details haven't been released yet. So if we read between the lines in the questions, we can gain some insights. They're asking about your company's current payroll, your ability to execute and operate during COVID-19. There's questions about where your customers are. None of these are difficult to answer questions. They're generally answered with a multiple choice answer. But there's clearly some implications. They're trying to understand how well established your business is, how much it's innovating, if it's an exporter, and if it needs financial assistance, most importantly. So for everybody on the line, the premise here is still that this is going to fundamentally be a wage subsidy that is responding to the way COVID's affecting your business. So you'll have to describe through a multiple choice question how it is impacting your operations and how much financial assistance you may require. So Mary, it's hard to say. 8 questions, and there's got to be a scoring grid, but we don't have all the answers. We can just read in from the questions.
Perfect. So a few things. So as you mentioned, there's about 8 or 10 questions. Most of them are drop-down menu type multiple choice questions with small, explain further in a paragraph. Some information that you would need to have to apply is you need to know how many T4 and T4A employees you had as of, I believe it's March 15th or some date in March of this year. So you would want to have that information handy. Because time is of the essence for this particular subsidy, is there a downside to a company that isn't sure if they would hit the criteria for CEWS? Is there a downside in them applying for this program?
I think so, because I don't believe you'll be able to revisit CEWS after applying for IAP. I'm not sure what mechanism will govern that, but clearly the part of the application is you attesting that you don't qualify for CEWS. So I just want to say, unfortunately, they are going to need to make a decision about the benefits of each program in comparison to each other.
What about if I were a company and I didn't think I qualified, or I believed that I would struggle to find a justifiable way to qualify for CEWS, and I applied for the IAP program and was denied. But then let's assume CEWS extended out to September, and in July, August, and September, I was able to get into the CEWS criteria. Would I still be precluded from applying to CEWS?
Well, this is an interesting question. So first, for those with entrepreneurial spirit, I think you should act with a clear conscience, but always try to make use of these government programs. So we don't have direction, but let me walk you through some options. I'm going to slightly rephrase so I'm comfortable answering. If right now you have concerns about being able to meet the CEWS requirements and you believe that you won't qualify, as Paul said, don't try to move transactions around to make yourself qualify. If you find yourself considering that, stop, consult an accounting professional and consider IAP. So unless you get clear direction, I would say don't proceed with a risky CEWS application at this time. It's a very serious program. We do expect the CRA to follow up on the CEWS revenue statements seriously. They did add additional penalties for companies misrepresenting that are CEWS specific. So if you find yourself suspicious of your eligibility, I'll say absolutely look at IAP. If you don't succeed with IAP, I suspect you can revisit CEWS, but we simply have no guidance in that matter. So that's where I'll say, pointing back to entrepreneurial spirit and acting with a clear conscience, I believe you would have a duty to apply for CEWS if you did not receive IAP funding. And we expect to get feedback from the IAP program on March 11th, or May 11th, excuse me, May 11th. So we won't be waiting that long. That's the benefit of a multiple choice application form.
And so, I'd like to open the floor to any Q&As at this time. We have about 5 minutes left on the webinar. We do have one question here. It says, do you think that pre-revenue companies would be eligible for IAP?
Yeah, absolutely. The IAP is specifically designed to include pre-revenue companies. It's 100% intended to include that demographic. And if you look at the application, although it's described as a wage subsidy, there are even questions that allow you to elect that you aren't currently paying wages. So if we do have entrepreneurs on the line who aren't even drawing a salary, you could fill out the form. I have to caution you that I'm not sure you would be stacked ranked very high if you had no revenue and you weren't paying any wages. I'm not sure you'd be successful in this wage subsidy. But you absolutely can still apply, and we'll see how far the government's 250 million goes based on the applicants that can get in before the end of day tomorrow. So a long answer there, but for IAP, I think that it's a great program, even if you're pre-revenue, limited revenue. You're going to be asked questions about how you intend to earn revenue in your plans. So,
yeah, and guys, it's Jamie. If I could just add one comment, and this is just speculation, but part of the speculation is regarding they want to see who applies and what their profile is. So in other words, they're looking to see, well, who's falling through the cracks with regards to CEWS, and perhaps part of the reason that this is a very tight window for round one of IAP is so I guess updates to that program could be made for subsequent rounds. So if they see a certain group of companies, well, they're just not getting relief and we need to recraft or pivot this somehow, it's going to give them an opportunity to do that. So again, just speculation, but that's part of the thinking I have right now.
I think there's a great question that just popped up in the chat. If a company believed that they did not qualify for CEWS and went ahead and applied for the IAP program, what happens if they now, based on new information that they've learned, now believe that they would qualify for CEWS? Is there a way for them to cancel that IAP application?
this is Rick, and I'll try to answer that in part. So I'll say that as a part of your application for CEWS, it does not ask about IAP. It's a unidirectional test. So only in IAP does it ask about CES applicability. So in this situation, I think you could, Tony, it's really tough to answer this question, but you may be able to decline IAP and proceed with a CEWS application. It might be possible because technically the CEWS application form does not address IAP at this time. If you were to receive both assistance programs, you may be able to decline one, or you may see a reduction in our offset because of the two. But the intention when you first apply to IAP has to be with clear conscience, no guilt that you are not applying for CEWS. So I think we had one question of someone who did that with the best intentions and is now reconsidering their position. I think we could, you might be able to pivot. It's exciting times. It's the Wild West for funding, Mary.
I would highly recommend that you document attending this call and what you learned and why you now feel you qualify for CEWS, just so you have it. And with that, Lucy, I don't see any more questions, so I hand it back over to you.
All right. First thing, I have to thank you, Mary, Paul, Rick, and Jamie. That was very well prepared and very informative. So thanks a lot. So for those of you on the call, we will have other sessions like this on the relief measures. So the way for you to stay in touch is subscribe to our newsletter, follow us on social media, and also we have an email address. If you have suggestions for the next event, or if you have a story about how the crisis is impacting you, you can email us at advocacy@interactiveontario.com. So it's advocacy@interactiveontario.com. So without further ado, Thank you all. Thank you to the panelists, and good luck, everyone. Bye.